Coming up on Market to Market. The Agriculture Committee taps the brakes on speedy trades. A switchover for aging oil tank cars may take more than a decade. And new wheat hybrids are closer than you think. Those stories and market analysis with Dan Hueber next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. This is the Friday, July 15 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. If the Fed was looking for signs the economy was perking up, they wouldn't be betting on June's inflation rate. According to the Labor Department, the Consumer Price Index rose a modest 0.2% last month. When gasoline and food are pulled out, core CPI rose the same amount. The annualized rate stands at only 1%. Retail sales, however, did post a healthy 0.6% gain. Without automobile sales, the rate was 0.7% stronger in June. The news added fuel to the fire as profit-taking and the search for undervalued investments pushed both the Dow and S&P 500 to record levels during the week. The drive to cover your bets was echoed in the halls of Congress. Efforts to stop a 50-state patchwork of GMO labeling laws was averted as the House passed the Senate's version of the controversial bill, sent it off to the White House, and adjourned for a 51-day recess. Before the rush to the exits, the House Agriculture Committee took a closer look at setting up cameras on the high-speed trading superhighway. Peter Tubbs reports.
The House Agriculture Committee took testimony this week from trading firms who oppose new rules proposed by the Commodity Futures Trading Commission. If adopted, the new rules would affect a broad swath of the automatic trading, or AT, infrastructure.
What percentage of market participants do you think would qualify as AT persons?
Automated trading is used by a lot of different types of market participants in one form or another. There are people who use highly sophisticated systems that they develop themselves, but there are people who also increasingly use systems that are provided by software vendors for them to execute more efficiently within the futures markets. Trying to quantify how much of the market is truly algorithmic in nature, it's going to actually be a very high percentage.
Both witnesses and representatives were concerned that adhering to the regulations would force small traders, such as local co-ops, out of futures markets. The benefit of electronic automatic trading to customers has been a lowering of costs in the trading process.
And if you look at the data, sort of end-user costs in a variety of markets that have become increasingly electronic, increasingly automated, and in turn increasingly competitive, the result is that the cost to the end user are much lower.
A primary concern of trading and investment firms is a requirement to share trade-making algorithms with the Commission. Those summoned to Capitol Hill to discuss the matter say the regulations would be ineffective and a breach of their intellectual property rights.
It is highly proprietary trade secret information that could expose the fundamental aspects of a business that provide economic advantage over competitors. Making such valuable intellectual property readily available to the Commission is unnecessary to fulfill the intent of the regulations.
Despite concerns over the high-speed nature of electronic trading, investment firms maintain that the electrification of trading mechanisms has increased transparency and allows for easier auditing of the trading process after a questionable trading event. For Market to Market, I'm Peter Tubbs.
A recent increase in rail accidents involving the aging petroleum tank car fleet has prompted the National Transportation Safety Board to ask railroad companies for a comprehensive plan to handle oil spills. No matter what happens, the petroleum tank car fleet will be making a switchover. John Torpy explains.
Older oil tank cars, viewed as the culprits of many rail accidents, could remain in service for more than a decade. Under new federal rules, the rail industry has until 2029 to upgrade an aging fleet of tank cars to newer, safer models. At least 27 accidents involving older tank cars transporting crude oil or ethanol have occurred in North America in the last decade. One of the worst was in Lac-Mégantic, Quebec, where 47 people died in 2013. Last month, near Mosier, Oregon, tankers damaged during a derailment spilled 42,000 gallons of crude oil that erupted into a massive fire. Lower oil prices and a reduction in the use of coal have translated into fewer rail shipments, allowing more time to switch to newer, safer tank cars. However, a loophole in the regulations will allow older cars to be pressed back into service if there is an increase in demand. For Market to Market, I'm John Torpy.
In the middle of the last century, Dr. Norman Borlaug crossbred several wheat strains to develop varieties that helped save more than 1 billion lives. While the father of the Green Revolution passed away in 2009, research has never stopped. And as producer Colleen Bradford-Krantz discovered, several groups are in the hunt for a small grain hybrid that can affordably keep nature at arm's length.
While hybrids have long dominated corn production, wheat producers never fully embraced the few hybrid options made available in the past. In recent years, however, seed companies have begun reinvesting in the development of hybrid wheat seed. Both corporate and academic researchers believe the recent, nearly complete mapping of bread wheat's complex genetic code will improve the ability of scientists to blend traits like high yield, disease resistance, and drought tolerance in hybrid seeds.
If you want to measure the interest in hybrids, I think it's interesting to just look at the number of companies that list them in their announcements to shareholders. And right now, the 5 or 6 largest companies working in wheat breeding all have, at least in their portfolio, some interest in hybrids.
Souza, Bayer Crop Science's director of global wheat breeding, works in a newly built $17 million facility near Beaver Crossing, Nebraska. Much of the research is focused on wheat hybrid seed development. And Bayer isn't alone. Seed companies Syngenta and DuPont Pioneer are among those in the hunt for the ideal wheat hybrid. According to scientists, corn hybridization is a relatively simple process where pollen is transferred from plant to plant. Wheat and soybeans are self-pollinating plants, however, making crossbreeding more complicated.
Wheat hybrids started in the 1960s with the identification of the sterility factors that would allow the cross-pollination. There have been several commercial attempts that have, some have succeeded for an extended period of time, others have failed, largely due to the inability to manipulate the genetics, that is, track the genes needed for the hybridization system in wheat.
Since 2005, a group of more than 1,100 wheat breeders and plant scientists in 55 countries have worked together to map the wheat genome. Last year, after 9 years of work, the group released a chromosome-based draft genome sequence in the journal Science.
Just to give you an example, the entire set of chromosomes for rice, or all the genetic information in rice, would fit into only one of the 21 chromosomes of wheat. So that gives you an idea of just how complex it is.
Both Syngenta and Bayer officials say they expect to release a wheat hybrid by the end of 2020. While the majority of the research appears to be using information from the genome map, many scientists are still using traditional breeding methods. Souza says there isn't any work being done on genetically modified wheat at Bayer's Nebraska Research Center. However, the work on GM wheat is taking place elsewhere in the world.
We are investing in a wide range of technologies, primarily because we think that different consumers, different countries may have different levels of acceptance of that technology. Because of the timelines to develop these technologies, it's hard to know what public perception may be in the future.
Nebraska farmer and seed dealer Mark Noble said he believes there is great production potential for GM wheat, but doesn't think the public is ready for it.
If people are telling us they don't want GMOs, then I don't think we're going to have it in wheat. I think most companies and universities would be scared off of that. Hunger and things like that change things. It's just like electricity. People don't like a power plant until their power goes out. Then all of a sudden they're okay. And I think that's be the same thing with food. Some people don't like GMOs until they don't have some food. And then I think the GMOs might be a really positive thing.
Noble expects that the new seeds, which can take more than a dozen years to develop, will provide a modest boost in yield.
The incremental advancements, from what I've been told, is going to be more like what sorghum was years ago, probably more in the realm of 10 to 15%. I think maybe to keep expectations reasonable.
Noble imagines being able to select a hybrid that will not only yield better, but also work best for secondary customers. He imagines a niche hybrid seed market that can begin with the farmer considering more precisely what a particular mill or bakery might want with their flour. Professor Sunish Sehgal and his South Dakota State University research team take these desired traits into account as they analyze hundreds of winter wheat varieties each year.
We have about 900 crosses every year. We test about 15,000 head rows. And in yield trials, we test about 7,000 to 8,000 plots every year to identify one line which can be released as a superior variety, which is better than what is available and solves some of the challenges which the producer is facing.
After evaluating the top wheat varieties in the Great Plains, from Texas to North Dakota, Sehgal and his team crossed the best with other wheat varieties developed at the university. Those that show the best mix of disease resistance and extreme weather tolerance are tested in field trials for several years. Finally, they study which varieties also produce high yields. Noble says it seems as though wheat farmers have been waiting for that perfect hybrid for decades.
I think our wheat breeder here at the university said one sign that wouldn't have gone out of style for the last 25 years is hybrid wheat is right around the corner. We will have to come together on the cost of the seed, and we will have to get enough incremental advancements out of this hybrid wheat to justify the producer to use it, or hybrid wheat won't last.
Noble, like others, still believes, however, that the next 5 to 10 years may finally offer the breakthrough hybrid varieties that work for both producers and processors. For Market to Market, I'm Colleen Bradford Krantz.
Next, the Market to Market Report.
It's possible commodity traders were mimicking the latest Pokemon craze this week, looking at their smartphones and bumping into unseen passersby. However, it is less likely they were trying to catch them all, and more likely they were after elusive profits. For the week, September wheat fell a dime. The nearby corn contract continued its losing streak, falling 3 cents. Weather markets and quarterly stocks had little effect on the nearby market as the August soybean contract fell 11 cents. August meal followed the trend, going $6.90 per ton lower. In the softs, July cotton added to last week's gains, leaping up $8.47 per hundredweight. Over in the dairy parlor, August Class 3 milk futures gained 54 cents. The livestock sector was down as the August cattle contract fell $1.30. August feeders dropped $3.88, and the June lean hog contract shed 90 cents. In the currency markets, the U.S. dollar index moved 85 points higher. Crude oil gained 54 cents per barrel. Gold retreated $31 per ounce. And the Goldman Sachs Commodity Index picked up almost 3 points to finish the week at 360.25. Here now to lend us his insight on these and other trends is one of our regular market analysts, Dan Hueber. Dan, welcome back.
Thanks very much. Glad to be here.
We are excited to have you, and I want to start off this discussion with a question from one of our Twitter followers.
Certainly.
This one comes from Nathan in Inwood, Iowa. And Nathan says, after months of trading sideways this winter, is the more recent volatility in grains the new normal?
Well, I think it's summer normal, certainly. And again, you always associate your most volatile periods, during that June, July, August period in corn and soybeans. So it's nice to see us have a pickup in activity. And of course, with volatility comes opportunity. But I would say it's probably not much outside of the norm, which, and again, look at option contracts. Options have your highest volatility in the summer months. it's because the greatest risk of producing the crop is out there. So the two are hand in hand.
Weather, weather, and the crops in the field.
Absolutely.
All right. Well, let's talk this wheat market.
Certainly.
We have a lot of winter wheat piling up out there.
Certainly.
How do producers manage that wheat, especially when they're producing, in some cases, double expected production when basis is collapsing and these futures markets aren't doing any favors?
Well, futures markets aren't really doing any favors. Now, granted, always you're going to have the, at the gut side of harvest, you're going to have some of the worst basis levels out there, assuming there's going to be a normal crop. Even extend that out, this could create some problems down the road for corn. I mean, if we're utilizing some of the space to store wheat in. But that said, I think you have to look at where the carry is in the market, move your hedges, move your sales out to the furthest you can as far as what's going to capitalize on the carry. We're going to get basis improvements. There's no two ways about it. I mean, demand is not certainly phenomenal. I mean, export sales were not great again this week on wheat. But on the same token, that once that glut kind of cleans up, we get the excesses off the front end of it here, we'll tend to see the basis improve. Granted, there's not much in the price picture right now that would say we have a lot of encouragement to the upside. So, if you think you're going to go for a price rally, don't do it with the cash. Maybe turn around and have your cash sold. Try to do it with a hedge to pick up a little basis. And if you want to be a bull, do it with a futures or options contract so you can limit the risk.
All right. Are you hearing some more wheat feeding happening out in the Plain States?
I honestly have not heard of that. I cannot imagine it's not happening, though. I mean, with the bushels out there, I mean, granted, corn is relatively cheap as well, but with the extra protein in the wheat, I just have to imagine we're going to see a nice pickup in feeding this year. So now granted, versus the last USDA report, billion bushels of wheat, we have a lot of wheat to get rid of. Same thing on a worldwide basis. But that said, there's this market seems to have found value down here. We just need a reason to kind of come out of the hole at some point.
Okay. So hopefully not a whole lot of downside left.
Exactly.
All right. Taking a look at this corn market, USDA report on Tuesday. Any surprises in there that jumped out at you?
Nothing huge by any stretch of the imagination. It was nice to finally have a little positive surprise instead of a negative surprise. Regardless, I mean, we tend to month by month, we get some kind of a shocker out there. Nothing was huge, but I think the trade really anticipated we would see the carry-in bumped up a little bit more after that grain stocks number. Of course, that wasn't the case. It was actually reduced just a little bit, so we did bump up some of the domestic usage a little bit. And honestly, I look at the corn market, and I think moving ahead, we're probably even a little bit understated on some of the export numbers. We're battling higher dollars and things, but I mean, when you look around the world right now, we're seeing a nice increase in a pickup in demand from some key areas. China, particularly. I mean, the last 2 months they have imported record quantities of corn. We know there's issues in Brazil. They're probably going to be a buyer of corn this year. So right now, yes, ultimately you're going to have Ukraine and Eastern Europe with corn, but we're kind of the only game in town, so it's a good position to be in at this point.
All right. Now, in the corn market and in the soybean market, there's been a lot of chatter about this perceived dome of doom, this hot spell that could be coming over the Corn Belt over the next 10 to 14 days. Absent that, or if it doesn't manifest as predicted,
correct,
can we see $4 December futures?
I think that's about the upper limit of December corn. No, without some kind of a spoof in there, well, I'll retract that a bit. That would certainly bring us there quickly. And, I think that possibility is there. Granted, 24 hours ago, dome of doom. 6 hours ago, maybe not so much dome of doom. So corn in less than 24 hours, we've had a 30-cent range. We've gone from 380 back to 350. I'm glad we bounced off of there for the weekly close. Now, I do think it doesn't necessarily have to happen in corn pollination. The beans are the ones that really kind of have the pump primed. If we could get a little excitement here in early August, maybe worried about weather there, or see another little surprise in the bean demand. It may be beans tugging corn up to those levels, but boy, we're getting late enough in the game right now to think we're going to get back above $4 corn. Looks a little bit questionable.
Okay, well, now let's talk about beans since you mentioned it. We did have the WASDE report on Tuesday. On the soybean side, it appeared to be relatively neutral on the face, and we saw soybeans shoot like a rocket up to the upside.
Well, of course, step back to the June 30th stocks and acreage report, those numbers were not bullish by any stretch of the imagination. Beans shot to the upside. So here again, I think beans very sensitive to the news. They recognize, and I think you can apply the same story to corn as well, that a very small change in the yield and acreage numbers are meaningless. 2 bushels less a bushel less on the soybean yield nationwide, and we could be back talking about 150 million bushel carryout instead of 290 for next year. So, I mean, there is still very little room for error. Again, I mean, this August period, and we know we associate August weather and how that bean's going to yield, and it's just a lot of things up in the air yet, literally, to see how this yield is going to be this year. So.
All right. The shining star this week in the futures market was a market that we often don't get time to cover, but this week we have to here on Market to Market.
Absolutely.
The cotton market.
Exactly.
$8 a hundredweight to the upside. What happened?
You know, a long overdue move, I guess you'd probably say. You know, really on the USDA reports, not domestically, if anything, maybe neutral to a little bit negative. World stocks, though, were actually cut, I believe, 9 million tons versus a year ago. I mean, it was not that quite a big reduction on the individual report. Plus, you're seeing, again, China being the 800-pound gorilla in the room. The Chinese interest in cotton, is outstripping what anybody had anticipated. So it's when you look at the cotton market over the last two and a half years, I mean, we have been stuck in this range, basically trading 66, 68 cents to the upper side, 62, 63 cents on the low side, and we've just ranged back and forth. And, when you get into those long extended periods like that, I think traders will often become complacent. Oh, this is easy. You get 67, 68 cents, you sell it, you get to the low side, you buy it back, and we can just play that game. And they've been very successful doing that since 2014. Well, this week, once you push through the upper side, it's not unlike a pressure cooker where the lid blows off. There's a rush for the exits. All these people who have been very comfortable shorting at the 66 to 68 cent range, all of a sudden, this is not so much fun anymore. So they all rush out, and it just fed on itself right through the close here today. So it probably a long-term signal that the bottom is in. Okay. It's a new pattern. Not that you can sustain this move necessarily for extended periods, but it's at least broken us out of that commodity doldrums.
Are you aggressively selling bushels you're confident in up in these levels, or do you wait to see if we can run it a little farther?
I think you certainly have to reward it for the crop that's out there this year. This really kind of comes back to that whole macro picture as well, though, that I'm still a firm believer that the major commodity lows are behind us. They were put back in December, January of last year. And, the definition of an up market or a bull market is you're going to consistently put in higher highs and higher lows over time. Mm-hmm. Now, granted, the whole commodity sector right now is maybe a little bit overdone. Okay. Of course, you wouldn't know it by the ags, but, gold and crude, we've had some very substantial moves. Looks like we need to back that down a little bit. Now, cotton's probably going to fit in that same thing, but when you have turned the tide into a longer-term upcycle, you tend to find buyers on the brakes. You just don't get into these extended bear markets like you did, say 2011 to 2015.
Okay.
So.
Well, now let's test that theory. Major lows are behind us.
Certainly.
Live cattle down another $1.30. Where's the bottom in that market?
I guess I'm a little stunned that we have spent as much time or as much defensive action. The cattle, you can't see anything good happen here recently, but, that move has been slowing down. It's almost like we're trying to curve out this long-term major flat bottom. Cattle oftentimes when they get to the lows just get very volatile. I mean, it looks like you're going to improve and they slap it back down again. I mean, it's kind of this little game that goes back and forth until we ultimately realize that, all right, we've gotten it cheap enough that we're going to start developing demand again. Certainly the dollar being as strong as it has been, and this whole Brexit almost nonsense, but it is an impact on the dollar. We know there's this inverse correlation between the dollar and the commodity market, so I think psychologically that's, of course, worked against not only cattle and hogs, but the grain markets as well, with the exception of soybeans. But it's, so that's just a battle that we have to confront. So.
Now, you would think conventional wisdom would say new highs in the stock market. We should see some additional strength here in these beef markets, but we're not seeing it on the board.
I think unfortunately, when you look over at the indexes, the equity indexes, is it really a rally because we think the economy is performing all that well, or is it because it's the only game in town? I mean, you can't go out and earn anything on fixed interest. You've got to go to higher corporate bonds or higher risk corporate bonds. Here, I think in the last week, 20-year Japanese bonds went negative territory. First time ever. 20 years. I mean, it's,
Well,
so
I saw
we keep stretching it out.
A Swiss bond went negative a week, 10 days ago.
Right. So, I mean, realistically, what are you going to do with your money? So it's commodities commodities have helped. That has been one of the star performers as a whole, as a group this year, if you look at that, that Goldman Sachs index. But that said, there's not anything really in the traditional investment realm that offers a great alternative, so money just keeps flowing back into the equities.
So on cattle, feeders, and lives, you expect to be putting in a long-term graceful bottom.
Yes.
Where do you see hogs going from here?
Hogs have really been very much the same kind of struggle. I'm a little surprised we have remained down here as long as we have. I know the fall months especially got into a little bit of extra pressure here this week. I truly believe, we're not really, yes, the numbers have expanded some, but, we are seeing some pretty good interest on overseas business once again, particularly here again. China seems to be the person that our number one customer. And, thankfully, their economy came in at 6.7% again on their last GDP number, which a little better than expected. So hopefully that nation as a whole has stabilized. Interestingly enough, what they're really thinking they're going to see growth on is in consumer spending and services. Sounds kind of familiar to U.S. economy, but yes, absolutely. If the consumers are spending, that would ultimately have to be a good thing for our commodities.
Making that transition from a manufacturing exporting to a service-based economy.
Correct.
Interesting. Yep. Dollar on this next week, higher or lower?
We did sneak out a little bit of a gain this week. I tend to think I'm going to favor the upside. Not because I'm necessarily a big dollar bull per se, but here again, just enough uncertainty with what's going to happen with all the turmoil in Europe. Not to mention the disaster down in France here this weekend, which when people are scared, they want to tend to come back to the dollar. So it would tend to favor it right now.
Trend is our friend in the dollar.
Yes.
All right. Dan Hueber, thank you so much for joining us.
My pleasure. Thank you.
That wraps up the broadcast portion of Market to Market, but Dan and I will keep the market conversation going, including answering more of your questions during Market Plus, available on our website. And like us on Facebook. You'll find links to some of our videos, and you never know when we might go live for a behind-the-scenes report like we did this week with a series of special announcements. And join us again next week when we examine one man's legacy that stretched from High Plains ranch lands to the packing house floor. So until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com.